Hey everyone, welcome back for another deep dive. This time we're going way back to 1979
Oh, wow.
to take a look at Warren Buffett's letter to Berkshire Hathaway shareholders that year.
I love this letter.
It's pretty fascinating,
Yeah.
right? I mean, especially considering all the parallels to the economy today.
Yeah, you almost think he was writing about 2025.
Right. I mean,
Mhm.
1979, crazy high inflation, just like what we're dealing with.
It was a wild time.
So we've got excerpts from the letter itself,
Okay.
but also this great article that kind of pulls out the big ideas and makes them a little easier to digest.
That's helpful.
So one of the things that Buffett jumps right into is this idea of understanding accounting.
Ah, yes, the foundation.
Yeah, he really emphasizes that. And, it was a particularly important time to be talking about it because back then there was this big shift happening in how insurance companies were reporting their investments.
Right.
They had to start using market value
Yeah.
instead of, that lower of cost or market approach.
So instead of just what they paid, they had to account for how much those assets were actually worth at that moment.
Exactly. And it sounds pretty technical, but Buffett actually makes it kind of funny,
Okay.
you know?
He's a master at explaining complex things simply.
He is. He's like, imagine judging a bakery
Okay.
only on the price of flour that day.
I like where this is going.
So, yeah, flour prices go up.
Sure, the bakery's assets on paper look more valuable
Right. But does that actually mean they're baking more bread?
or making more profit. Not necessarily.
Exactly. And that's his point. Like, it's so easy to get tricked by those surface level numbers.
It's all about looking deeper.
And this leads him to one of my favorite parts of the letter where he talks about why return on equity, or ROE,
Right.
is a way better measure of a company's performance than just looking at earnings per share.
Yeah. EPS can be misleading.
Totally. So explain this to me like I'm 5.
All right, so imagine you've got this savings account.
Right.
Super basic fixed interest rate.
Yeah.
Every year you get your statement and you see those earnings per share.
You mean the interest.
Yeah, basically your interest grows nice and steady, but
But what if inflation is like 10%?
exactly.
Yeah, yeah.
Are you really getting ahead if everything costs more?
Not really. I'm just keeping up.
Exactly. And that's why ROE is so important. It tells you how effectively a company is actually using its capital to generate returns.
So it's not just about making money.
It's about making more money than it costs you to use that money.
Ah, so it's like, are they actually growing the business in a meaningful way?
Exactly. It's about the quality of those earnings, not just the quantity.
And this totally ties back to what we were saying earlier about 1979 and those similarities to the economy today.
Yeah. It's like Buffett was giving us a playbook for navigating these turbulent times.
I love that, a playbook. So high inflation, low returns on fixed income investments.
Sounds familiar, doesn't it?
Too familiar.
But what's really cool is that Buffett doesn't just describe the problems,
He's got ideas.
He gives you a framework for thinking about them.
Okay, so give us an example.
Well, he introduces this concept he calls the investor's misery index.
No, that sounds scary.
Well, it can be. It's basically combining inflation and taxes and seeing how they shrink your investment returns.
Oh, man.
Like, imagine earning a 20% annual return on your investments.
Sounds pretty awesome.
Right. But then inflation is running at, let's say, 12%.
Ouch.
And you're paying taxes on those gains.
So suddenly that 20% doesn't look so great anymore.
It could even be a negative real return.
Whoa. So you could be losing money even when it looks like you're winning.
That's the sneaky thing about inflation.
So it's not just about earning returns. It's about making sure those returns outpace inflation and taxes.
You got it. It's about preserving your purchasing power over the long term.
Okay, that makes sense.
And that's where Buffett's investment philosophy really shines through. He talks about how Berkshire achieved this amazing 20.5% compounded annual gain in book value per share.
From when to when?
All the way from 1964 to 1979.
Wow, that's incredible. How do they do that during such a crazy time?
Well, for starters, Buffett has always been a long-term thinker.
Yeah, he's not about those quick flips.
Exactly. He's building a portfolio for the long haul. He's not trying to time the market or chase those short-term gains.
So it's about writing out those dips and focusing on the bigger picture.
Exactly. But it's not just about patience. It's about choosing the right companies.
Okay, so how do we do that? How do we find those gems?
Well, Buffett makes this really important distinction between buying good businesses at a fair price
Okay,
versus buying poor businesses at a bargain price.
so it's not just about finding a deal.
Right. He actually uses a personal example to illustrate this point.
Oh yeah, his investment in, what was it, Wambeck Mills.
That's the one. He thought he could turn the company around, classic value investing.
But it didn't really work out.
It was way harder and more costly than he expected.
Hmm.
He basically learned that a bargain price doesn't mean much if the business itself is fundamentally flawed.
So it's not just about finding a deal. It's about finding a great company, even if you have to pay a little more upfront.
Exactly. And that's where this idea of moats comes in.
Moots, like around a castle.
Exactly. It's a metaphor for those sustainable competitive advantages, things that protect a company's profits and market share from competitors.
So basically, like a company with a wide moat is harder to attack.
Precisely.
Okay, so this is all starting to click together. Look beyond the surface numbers, find companies with strong ROE and durable moats, and be patient enough to ride out the ups and downs.
You got it.
And this is just the tip of the iceberg.
There's so much more to unpack in this letter. It's like a treasure trove of wisdom.
I'm ready to keep digging.
Let's do it.
Okay, so we've been talking about good businesses and, finding those companies with those strong moats.
Right, those castles that can withstand the competition.
But let's get specific.
Let's dive in.
What does this actually look like, when we look at Berkshire Hathaway back in 1979?
Well, one of the things that jumps out at me is how diversified they already were.
Yeah, it's like a mini conglomerate, even back then.
Right. They had insurance, textiles, retail, even a bank.
So he was already spreading that risk.
Exactly. And remember, this is during a period of high inflation, economic uncertainty. Having that mix of businesses definitely helps when one sector isn't doing so well.
Makes sense. It's like that old saying about not putting all your eggs in one basket.
Exactly. You got to spread that risk.
But even with a diversified portfolio, Buffett doesn't shy away from talking about the challenges they faced.
Right. He's always upfront about the good and the bad.
Like he specifically mentions their textile business,
Yeah, that was a tough one.
struggling despite, some bright spots.
And this is where he really drives home that point about focusing on good businesses from the start.
Right.
Because turning around a struggling company is like trying to swim upstream.
That's a good analogy.
It takes a lot more effort, and it's not always successful.
It's way easier to just find a company that's already swimming with the current.
Exactly. Find a business that has that momentum already built in.
And he even talks about how, even within an industry that's generally considered strong, like insurance,
Right? Insurance is usually a pretty safe bet.
there can still be hidden dangers.
There are always risks.
He actually predicts tougher times ahead for the insurance industry.
He was right about that one.
And he was particularly wary of the reinsurance business, where companies are insuring other insurance companies.
Yeah, that's a whole other level of risk.
So what was he so worried about there?
Well, he saw too much competition and this tendency to chase market share by lowering prices.
Even if it meant taking on more risk.
Exactly. It's like offering fire insurance in a pyromaniac convention,
Yikes, that's a recipe for disaster.
Sooner or later, it's going to backfire.
So how do you avoid those kinds of pitfalls in the insurance world?
Buffett really emphasizes underwriting discipline.
Which is?
It's all about carefully assessing risks and setting premiums accordingly.
Yeah.
Really knowing what you're getting into.
Ah, I see it.
And he highlights some of his managers who were great at this, like Phil Leach at National Indemnity
Yeah.
and Milt Thornton at Cypress Insurance. They weren't afraid to say no to risky business.
Even if it meant missing out on some quick profits.
Exactly. They were playing the long game.
So it all comes back to that long-term thinking.
Always.
And finding those talented managers who can really execute on that vision.
Right, because good businesses are built by good people.
He seems to really trust his team.
He does. He talks about his decentralized management style.
Me
He
too.
gives his managers a lot of autonomy. It's almost like they're running their own mini businesses within Berkshire.
So he's not a micromanager.
Definitely not. He sets the overall strategy, but he trusts his team to make those day-to-day decisions.
Interesting. So that hands-off approach extends to how he communicates with shareholders too.
Right. He believes in transparency and treating shareholders like partners.
Not just, passive investors.
Exactly.
And that definitely comes across in his letters.
It's like he's having a conversation with you.
He's so clear and straightforward, and, he's not afraid to admit when he makes a mistake.
Right. There's this refreshing honesty.
Oh, and speaking of honesty, remember what he said about long-term bonds?
Oh, yeah. He was not a fan.
That was a pretty bold statement.
He basically said buying long-term bonds in an inflationary environment is like signing a fixed-price contract for goods and services years down the line.
So it's like agreeing to buy a gallon of milk for $5 in 2035.
You'd be laughed out of the grocery store.
Right. But that's essentially what people are doing when they buy those long-term bonds with fixed interest rates during high inflation.
They're locking in a guaranteed loss of purchasing power.
Ouch.
And instead of bonds, He was much more interested in things like convertible bonds,
Okay.
which offer more flexibility and potential upside.
Ah, I see.
He was always looking for ways to preserve capital and generate real returns that could outpace inflation.
Instead of just settling for that fixed return, that might be worth a lot less in the future.
Exactly.
It's another example of him thinking ahead, challenging conventional wisdom.
Absolutely.
Hmm.
And he even draws a parallel to Berkshire's own businesses.
Yeah.
He says he wouldn't agree to sell a pound of See's candy or a yard of Berkshire Hathaway cloth at a fixed price decades into the future.
So why would he lock in a fixed return on his investments?
Exactly. He's applying the same logic across the board.
It's a really powerful way to think about it. It's like investing isn't just about picking stocks.
It's about understanding the bigger economic picture and adapting your strategy accordingly.
And it's about building that community of shareholders who are all on the same page.
Right. He wants to attract those long-term investors who understand his approach and believe in his philosophy.
He's not interested in those short-term traders who are just looking to make a quick buck.
He wants partners who are aligned with his goals.
And that philosophy, it's reflected in his whole communication style.
Definitely.
He's so open and honest and engaging.
He treats his shareholders with respect.
Like he wants them to be informed and involved.
Exactly. It's so different from what you see from a lot of companies today.
It really is. It's like with so many companies, it's all about spin and hype.
But Buffett cuts through the noise.
He's just straight up with you.
He shares his insights and perspectives in a way that's both informative and entertaining.
That's why his letters are so timeless.
He's not just a brilliant investor, he's also a master communicator.
It's like he's sitting down with you, sharing his wisdom and experience.
And it's amazing to think that even though this letter was written nearly 50 years ago,
Right.
the lessons are still so relevant today.
It's crazy how much has changed, but how much has also stayed the same.
The fundamentals never go out of style.
They don't. It's a testament to focusing on those fundamentals, taking that long-term view and building that strong foundation.
He's giving us a roadmap for navigating turbulent times.
I like that, a roadmap.
And a reminder that even in times of uncertainty, there's always opportunity out there.
It's funny, we've been talking about this letter from 1979.
Right, almost 50 years ago.
But it feels like we're getting a crash course in how to invest in 2025.
It's amazing how relevant it still is.
So much of what Buffett talks about, those economic challenges, the strategies he used.
It's all incredibly timely.
It's like he was looking into a crystal ball or something.
He definitely had a knack for seeing the big picture.
And for connecting the dots between, the economic landscape and those specific investment strategies.
Right. It's all about understanding the context.
Like, remember that image of the investor's misery index?
Oh, yeah, that was a powerful one.
Even a 20% return could get wiped out by inflation and taxes.
Especially now with inflation still on everyone's minds.
It makes you think twice about what a good return really looks like.
It's not just about chasing the highest number. You got to factor in those hidden costs.
Okay, so as we wrap up this deep dive, what's the one big takeaway you'd want our listeners to remember from this letter? What's that golden nugget they should keep in mind as they navigate their own investment journey?
For me, it goes back to that idea of community.
Community.
Yeah, remember how Buffett talks about attracting the right kind of shareholders?
Those who believe in Berkshire's long-term vision.
Exactly. It's not just about buying stock. It's about aligning yourself with companies that share your values.
Oh, that's interesting. So it's like finding your tribe.
Exactly. And investing alongside people you trust.
It makes sense you wouldn't go on a road trip with someone who hates driving, right?
Right. You want to be surrounded by people who are headed in the same direction.
People who share those same values and goals.
This goes beyond just investing, too.
Oh, how so?
It's about finding those mentors, learning from others, having that network of support.
Oh, that's so important, especially when things get a little rocky in the market.
Exactly, because investing can be intimidating sometimes.
It definitely can be, especially for new investors.
Having that community can make all the difference.
That's like having a safety net.
And a source of encouragement.
So true. Well, it's been an amazing conversation.
I always learn something new every time I revisit this letter.
Me too. It's a reminder that those fundamentals of good business, smart investing.
I never really go out of style.
And you know what else struck me?
What's that?
He mentions how Berkshire was able to achieve those amazing returns without using much debt.
Oh, yeah, he was always pretty conservative with leverage.
It seems like he preferred working with the capital they already had.
He believed in building a strong foundation.
But it makes me wonder, in today's world, with interest rates still relatively low,
Right.
is there a case to be made for using a little more leverage to maybe speed up growth?
That's a great question, something for our listeners to ponder.
It's all about finding that balance, right?
Risk versus reward.
What's your comfort level? How much risk are you willing to take on?
There's no one-size-fits-all answer.
Well, this has been a fantastic deep dive into Warren Buffett's 1979 wisdom.
Timeless insights.
Absolutely. And I hope it's inspired our listeners to keep those minds curious.
Keep learning, keep growing those portfolios.
And until next time, happy investing, everyone.